macro currency signals.
There's a difference between a market that is rising and a market that is about to break something. Silver right now is not simply going up. It is approaching a structural fault line that most people don't even realize exists. For years, the narrative around silver revolved around manipulation, shadowy banks, spoofing desks, fines that made headlines, traders gaming the system. And while those things may exist at the margins, they are not the core issue. The real distortion is not a conspiracy. It is structural. It is built into the architecture of the futures market itself. Because the moment you allow a system where unlimited contracts can be created against a finite physical asset, settled in cash if necessary, you create a pressure imbalance. And that imbalance works fine until it doesn't. Most commodities behave predictably. When wheat gets expensive, people consume less. When oil spikes, demand slows. Price increases eventually cool their own momentum because the underlying goods are consumables. But silver is different. Silver is consumed industrially, yes, but silver is also monetary, and monetary commodities do not follow the same feedback loops. Before we dive deeper, if this analysis is hitting the way it should, make sure you're subscribed and have alerts turned on. In shifts like this, being early isn't optional. It's everything. Jump into the comments and let me know where you're watching from and what time it is where you are. This isn't a local discussion, it's global. And seeing how far this message travels always says more than any headline ever could. All right, now let's get back to what just unfolded. When the price of a consumable rises, demand falls. When the price of a monetary metal rises fast enough, demand can increase. That is the key difference. At low prices, silver looks like an industrial metal. At accelerating prices, silver starts to look like money again. And when silver begins acting like money, something unprecedented happens inside the futures structure. The positive feedback loop begins. Price rises. That rise signals monetary weakness elsewhere. More capital flows in. More contracts are demanded. More physical delivery is requested. More stress is placed on a system that was designed under the assumption that most participants would settle in cash. The futures market depends on apathy toward delivery. It depends on participants not actually wanting the metal. But what happens when more participants want the metal? That is the moment silver begins to do something it has never done before. Because if enough contracts stand for delivery at once, the paper system strains. If the physical metal is drawn down faster than it can be replenished, confidence in settlement begins to crack. And when confidence cracks in a derivatives market, the response is not calm. Margins get raised, leverage gets squeezed, positions get liquidated mechanically, not because fundamentals changed, because survival mechanisms kick in. This is not malicious, it is self-preservation. Exchanges do not exist to protect traders, they exist to protect themselves. If stress intensifies, margin requirements can double overnight, contracts can be forced into cash settlement, trading can be halted, rules can be rewritten midstream. That sounds extreme, until you realize it has happened before in other metals. And silver's market is smaller than most people understand. It does not require infinite capital to create infinite pressure. Now add another layer. The global credit system is under strain. Debt levels are historically elevated. Long-term bond yields remain unstable. Confidence in sovereign balance sheets is fragile. When credit begins to look unstable, capital seeks something outside the liability structure. Gold responds first, silver follows, but silver is thinner. More volatile, more sensitive to marginal flows. If physical demand increases at the same time as derivative stress builds, the system reaches an inflection point. That is when silver stops behaving like a cyclical commodity and starts behaving like a monetary escape valve. And that is what makes this moment different, because silver has surged before. It has spiked to extremes, it has corrected violently, but it has never collided with a sovereign debt structure this large. It has never surged while global money supply expansion has been normalized for over a decade. It has never faced a derivatives architecture this leveraged relative to physical inventories. This time, the backdrop is different. And when backdrop changes, outcomes change. Now consider psychology. At first, silver's rise is mocked. Then it is debated. Then it is respected. Then it is feared. Right now, we are entering the respect phase. People who once dismissed it are asking where to buy. Not speculators, not momentum traders, people who never cared before. That shift matters, because monetary transitions begin at the margin. They do not begin with full-blown panic. They begin with quiet discomfort, with subtle doubt about currency stability, with subtle doubt about the reliability of paper claims. When that doubt crosses a threshold, behavior changes. People do not want paper exposure. They want possession, and possession stresses a system built on abstraction. Silver is uniquely positioned because it sits at the bottom of the credit pyramid. Currencies are liabilities. Bonds are liabilities. Stocks are claims on future productivity. Derivatives are layered claims on claims. But physical metal is not a liability. It does not depend on counterparty solvency. It does not depend on margin rules. It does not depend on liquidity facilities. It simply exists. That is why owning silver is not an investment in the traditional sense. It is a divestment from the credit structure. It is stepping down the pyramid toward the base layer. When enough participants step down simultaneously, the upper layers destabilize. And this is where the phrase "never done before" becomes meaningful. Silver has never forced a structural confrontation between physical reality and derivative abstraction at this scale, but it is moving toward that line. The more it rises, the more its monetary identity reasserts itself. The more its monetary identity reasserts itself, the more demand shifts from paper exposure to physical acquisition. The more physical is demanded, the more fragile leveraged paper becomes. That loop does not unwind gently. It accelerates. Now imagine one more layer. Suppose we experience another systemic credit event, a bank failure, a liquidity crisis, a sovereign stress spike. In that moment, leveraged assets across the board could sell off temporarily, even metals. But if the response to that crisis is aggressive liquidity expansion, which history suggests is likely, then confidence erosion deepens. And confidence erosion is silver's fuel. Because silver does not need inflation headlines to rise. It needs trust deterioration. And trust, once cracked, does not repair instantly. The explosive move in silver will not be a smooth climb. It will be chaotic. Margins raised, positions liquidated, short squeezes triggered, volatility expanding, headlines screaming disorder. But beneath that chaos will be a structural transition. A transition from silver as a traded asset to silver as a monetary refuge. That transition has not completed yet, but the early signals are visible. Inventory drawdowns matter. Delivery rates matter. Premium divergence matters. Physical shortages matter. Not in isolation, but in combination. When these signals align during sovereign stress, the future system is tested. And silver may do something it has never done before. Force a reckoning between paper and metal, not because of conspiracy, not because of intent, but because of math. Because unlimited paper claims cannot coexist indefinitely with finite physical supply when monetary demand awakens. That is the phase we are approaching. It will not feel orderly. It will feel unstable. But instability in a derivatives market tied to a monetary metal is not random. It is structural stress expressing itself. Silver has surged before. It has spiked before. It has corrected violently before. But it has never surged in an environment where the underlying credit system is this large, this leveraged, and this fragile. That is what makes 2026 different. That is what makes this moment potentially unprecedented. And that is why silver may be about to do something it has never done before. Now let's go further. Because if silver is about to do something it has never done before, it won't happen quietly, and it won't happen in isolation. It will happen at the exact moment the paper structure realizes it has underestimated physical reality. The futures market operates on confidence. It assumes that the vast majority of contracts will be rolled, offset, or settled in cash. It assumes that leverage will remain manageable. It assumes that delivery demand will stay within predictable boundaries. But assumptions work until behavior changes, and behavior changes when fear changes. Right now, silver is no longer just a trade for many participants. It is becoming an exit, not an investment in growth, not a speculative bet, an exit from counterparty risk. That shift matters more than price targets ever will, because when people treat silver as an exit rather than a trade, they don't want exposure, they want possession. And possession pressures inventory. Inventory pressure stresses the futures exchange. When inventories decline meaningfully relative to open interest, the system becomes fragile. Not visibly fragile at first, mechanically fragile. Then comes the margin lever. Exchanges have a powerful tool when volatility rises. They raise margin requirements. That forces leverage participants to either add capital or liquidate. If margins double overnight, many cannot add capital fast enough. Positions are liquidated automatically. Price may fall temporarily, not because demand vanished, but because leverage was forced out. This is how the system defends itself. But here's the paradox. Every time margins are raised aggressively, it sends a signal to the world that stress exists. And stress attracts more physical demand. Because physical buyers do not care about margin hikes. They are not leveraged. They are transferring value into metal. Now imagine this dynamic intensifying. Silver rises sharply. Margins are raised. Weak hands are flushed. Price dips violently. Physical demand increases on the dip. Inventories tighten further. Price resumes climbing. Each defensive action by the exchange becomes fuel for the physical market. That loop has never fully completed in silver at scale. We have seen short squeezes, we have seen parabolic spikes, but we have never seen a synchronized collision between sovereign debt instability, large-scale liquidity expansion, and a tightening physical silver market. This time, those forces are overlapping. Now consider what happens if delivery requests accelerate beyond comfort levels. The exchange has options: raise margins further, encourage cash settlement, change contract terms, temporarily halt trading. All of these are survival tools, and they are legal within the rulebook. But each intervention weakens the perception that paper claims equal physical reality. And perception is everything in a derivatives-based pricing system. If participants begin believing that paper silver may not translate into metal on demand, the value of paper contracts declines relative to physical bars. Premiums widen, spreads diverge, trust fractures, and that fracture can ripple across other markets. Because silver is not just another commodity, it sits near the base of the monetary structure. It is historically tied to currency systems. It is embedded in industrial supply chains. It is globally recognized. If confidence in silver derivatives weakens, it sends a signal far beyond one metal. It questions the reliability of paper settlement in general. That is why this moment carries more weight than previous cycles. In the past, silver spikes occurred within relatively stable sovereign debt structures. Today, sovereign debt itself is unstable. Long-term bond yields remain elevated. Interest expense is climbing. Governments cannot tolerate prolonged rate pressure without intervention. If another liquidity event emerges, a bank failure, a sovereign stress episode, a bond market panic, the likely response is aggressive monetary expansion. And aggressive monetary expansion fuels the perception that currency purchasing power is eroding. When purchasing power confidence erodes, monetary metals do not behave like commodities. They behave like lifeboats. Now imagine this scenario unfolding rapidly. Bond yields spike. Liquidity is injected, confidence weakens, silver surges, margins are raised, price dips, physical buying intensifies, inventory declines, exchange intervention increases, premiums widen, media narratives shift from volatile metal to systemic stress signal. At that stage, silver is no longer just rising. It is exposing structural fragility. That exposure is what silver has never done before at this scale. Not just spike in price, expose the plumbing. Now let's talk about timing. Monetary transitions often feel slow until they accelerate. For years, silver felt stagnant, range-bound, underperforming, ignored. Then it broke higher. Now volatility is expanding. Calls are increasing. Questions are changing. People who once dismissed it are asking logistical questions about availability. That psychological shift is subtle, but important. Because monetary change does not begin with panic. It begins with quiet doubt, and quiet doubt spreads. When doubt spreads, behavior shifts incrementally. Incremental shifts compound. Then the system reaches a threshold, and thresholds once crossed feel sudden. Silver has not yet broken the futures system. It has not yet triggered forced cash settlement. It has not yet caused exchange shutdowns, but it is moving toward a zone where those possibilities are no longer theoretical. And that is new. Silver has surged before, but it has never surged while the underlying credit pyramid was this tall, this leveraged, and this fragile. That is what makes this cycle different. And this is where discipline becomes critical. If you are holding physical silver, you are not participating in a trade. You are holding outside the liability system. If you are trading derivatives, you are inside the mechanical structure that can change rules at any time. Those are two different realities. The explosive phase, if it continues, will be volatile beyond comfort. There will be violent pullbacks. There will be forced liquidations. There may even be temporary price distortions. But beneath that volatility will be a structural shift, a shift in how silver is perceived, from speculative commodity to monetary foundation. And once perception shifts permanently, the pricing mechanism shifts with it. Silver, doing something it has never done before, does not mean it will simply go to a certain number. It means it could challenge the integrity of the pricing system itself. It means it could reveal the gap between paper and physical in a way that forces change, not through protest, not through conspiracy, through math, because math does not negotiate. Unlimited claims cannot coexist indefinitely with limited supply when demand for possession rises. That is the tension building beneath the surface. It may resolve smoothly, it may resolve violently, but it will resolve. And 2026 may be remembered not simply as a year when silver rose dramatically, but as the year when the market structure around silver was permanently altered. And maybe the most important thing to understand is this: when silver finally does what it has never done before, it won't feel like triumph at first. It will feel like instability. It will feel like volatility that doesn't make sense, like rules changing mid-game, like price moving too fast, then stopping abruptly, then exploding again. It will feel chaotic because structural change is never orderly. For decades, silver has lived inside a framework built on paper promises, contracts layered on contracts, claims layered on claims. Most participants never questioned whether the underlying metal actually mattered because delivery was rare and confidence was abundant. But confidence is thinning. And when confidence thins in a derivatives-driven pricing system, the underlying asset becomes the focal point. If silver forces a moment where paper and physical diverge in a visible way, if settlement becomes strained, If exchange interventions become more aggressive, that won't just be a headline. It will be a signal that the market is transitioning from abstraction back to substance. That transition is what silver has never fully completed in modern times. It has spiked, it has squeezed, it has crashed, but it has never forced a global reevaluation of how it is priced relative to its physical supply, while sovereign debt systems themselves were under pressure. That is the difference now. Silver is not rising in a vacuum. It is rising alongside debt stress, liquidity expansion, and growing doubt about long-term monetary stability. It is rising in a world where the credit pyramid is larger and more fragile than ever before. And if that pyramid begins to wobble in a serious way, capital will not move calmly, it will move urgently. In that urgency, paper exposure loses appeal. Counterparty risk becomes visible, and physical possession becomes the objective. If that shift accelerates, silver will not simply print higher numbers on a screen. It will challenge the mechanism that sets those numbers. That is what never done before truly means. Not just a price target, not just a breakout, a structural moment, a point where the assumptions that govern the market for decades are forced to adapt. And whether that adaptation is smooth or violent depends on how much stress builds before the system responds. So as we move deeper into 2026, watch more than price. Watch inventory, watch delivery, watch margin changes, watch bond markets, watch liquidity injections, watch the tone of policy responses. Because silver's story is not isolated. It is intertwined with the health of the entire credit structure. If that structure remains stable, silver may surge and settle into a higher range. But if that structure begins to fracture, silver could become the pressure gauge that reveals it first. And when pressure gauges spike, they don't lie. Silver may be about to do something it has never done before. Not because it wants to, not because of speculation, but because the environment around it demands it. And when environment changes at the foundation, outcomes change at the surface. Stay grounded, stay observant, and understand that what looks like volatility on a chart may actually be the sound of a monetary system adjusting to reality.